Hello there, welcome back. Our final part of chapter 2 then of your notes, we're going to have a look at the fundamental underlying assumptions that we must always apply when we're preparing our financial statements. Now, if you remember a couple of sessions ago, we looked at the statement of comprehensive income and the statement of financial position. Now, in order for them to be prepared properly, we as accountants must always assume certain things. Now, the first underlying assumption that we're going to discuss is going concern. Now, with going concern, what that says is that we always assume that the business is going to continue in operation for the foreseeable future. In other words, it will operate for more than a year, so more than one accounting period. So, we are preparing accounts on the assumption that the business will continue for the foreseeable future, assumed to be a year or greater. Now, what that means is that any non-current assets or liabilities can only be included in the financial statements at their cost or at that value only if going concern applies. Now, let me ask you this. What happens, or what would happen, if going concern does not apply? In other words, what would happen to the business's accounts if we thought it was likely that the business would actually wind up and close down in the next 12 months? Have a little think about this, maybe even pause the recording whilst you're having a think about it. Well, if we prepare accounts on a going concern basis, what we do is, for example, with non-current assets, we put them in at their original costs less any accumulated depreciation to give us their net book values. Now, the problem is, if the business is not expected to continue for the next 12 months, it's actually expected to shut down in the next 12 months, well, chances are that the original cost less the accumulated depreciation of that asset may not be the same as the amount that we could recover from disposing of that asset. Think about it. If the business is not continuing anymore, then the business has to get rid of all its assets, its property, its buildings, motor vehicles, machinery, etc. So putting it in at its original cost would not be the best way of valuing those assets. What we would have to do is value those assets at their forced sales value. In other words, if you have an asset, so let's say, I don't know, some motor vehicles that are in your books, in your accounts currently at $150,000, and you expect that when you close down your business you can only sell them for $20,000, well then it's the $20,000 that you need to record, not its original cost that we've seen in the pro forma. So going concern we always assume will apply unless we have good reason to know or to think that the business won't continue as a going concern in the future. And if we think that going concern does not apply, well then we're going to have to completely revalue all of the assets and liabilities in the statement of financial position. Okay, it's going to completely change the outlook of those financial statements. Now, in this syllabus, you will not be asked to prepare accounts where going concern does not apply, but you are expected to know what going concern is. And that's what we've seen there. So that's our first underlying assumption. Our second one is now going to be accruals. So let's have a look at the accruals assumption. Now, financial statements are prepared on the accruals basis, which means that we recognise transactions when they occur, irrespective of when cash is received or paid. So we recognise transactions when they occur, regardless of when cash is received or paid. Now, that's a really important underlying assumption, and it underpins an awful lot of transactions that you see. For example, if I sell goods to a customer on credit for $5,000 and that customer promises to pay me later, well, as we discussed, we said that obviously that customer would be a trade receivable, but we earned that income, that sales revenue, at the point that we invoice the customer. We don't wait until we receive the cash from the customer to record that sales income. We record it now when income is earned. Okay? So we'll just write that down. For example, credit sales. You recognise sale when income is earned. Okay, so when you've invoiced that customer. Right. Now the same thing could go with if we purchase goods on credit. So I purchase some goods from a supplier and I promise to pay them later. Well, I don't wait until I've physically paid the supplier to recognise the cost or the expense of that purchase. I recognise that purchase now once I've incurred that expense. So, purchases on credit. I recognise the purchase when the expense has been incurred. Okay. So I recognise the purchase expense when I've incurred that expense. So usually when I receive the invoice or the bill from the supplier. Now that can go for any other income or expenses. Remember we talked about this idea of accruals, an expense due but not yet paid for. I would have consumed the resource of electricity within the year, but maybe I won't receive the bill until the next accounting period. Well, I'm incurring that expense now as I'm using the electricity. I do not wait until I pay cash to the electricity board. I recognise it now. Okay. And again, the accruals concept you are going to see dotted around pretty much all of the syllabus. So it's something that I will constantly reiterate to you when we have a look at recording more transactions and events in later studies. So make sure you learn these underlying assumptions. Thank you.